StockPulse Newsroom, we are talking Fortuna silver mines. Fortuna trades as FSM in the NYSE in the States, FVI, Toronto Stock Exchange in Canada. We'll run through the details of their second quarter results. I've got the CEO, Jorge Ganoza. Jorge, I appreciate you taking the time here. I know I'll see you here in a couple of short weeks in Spokane. Looks like you put some numbers on the board, maybe a little mixed bag here. Certainly some strong numbers, nevertheless, but a little bit of a miss. Why don't you sort this out here for the market?
Yeah, no, first, thank you for the opportunity to be here again, Rob. Fortuna had a strong quarter. This business, mining, is driven by first physical metrics, right? So we pre-released gold and silver production for the quarter in July 11th. So for the first 6 months of the year, we have produced 129,000 ounces of gold and about 3.3 million ounces of silver. Gold and silver production is right in the middle of the fairway with respect to our annual guidance, right? So mid-year, we're right on target to meet annual guidance. So first, from that perspective, first half of the year, second quarter, strong delivery from our 4 operating mines. With respect to cost, early in the year, we provided annual guidance for cost, and 3 of our 4 mines are tracking on the upper end of the range for guidance. Inflationary pressures are real. I don't have to tell you about what's happening with diesel, but diesel, cyanide, steel, explosives, cement, those consumables that we use extensively at our mines are up, and therefore our costs have, in spite of some optimization and initiatives to contain cost, or costs have gravitated towards the upper range of guidance, but we are still within what we guided at the beginning of the year for costs. So from that perspective, I think it's been a good first half of the year, a good solid quarter. Our lowest cost operating mine, from an all-in sustaining cost perspective, runs at about $1,100 per ounce for gold. And at our highest cost operation, which is the Yaramoko mine in Burkina Faso in West Africa, we are producing gold for the first half of the year at around average $1,300 per ounce of silver, so with healthy margins. With respect to our financial headline numbers, we generated sales of $168 million for the second quarter. We generated healthy EBITDA, around $58 million. Our EBITDA margin has gotten a bit compressed. We traditionally operate with EBITDA margins over sales of 42%. We're down to 34% this second quarter. But in spite of that, we managed to generate healthy free cash flow, around $22 million of free cash flow from operations. And on the earnings per share, this has been a difficult quarter for most mining companies, peer mining companies. There have been some large impairments taken by some of our peers, and most of them, not all, but most, have been deep in the red with respect to earnings. And we managed to log a small gain of around $2 million adjusted. It's a small gain. We came below what was analyst consensus on earnings per share. Consensus was around 6 cents, and we came in at around 2 cents per share. Now, that was impacted by accounting losses. And what do I mean by that? For example, during the quarter, we had a write-down of inventories at our Yaramoko mine in Burkina Faso of around $4 million. That's an accounting adjustment. And then about 50% of our metals sold are sold in the form of concentrates that are delivered to smelters around the world. When you sell concentrates, you get provisional pricing that is adjusted at the end, a month after delivery. So you are exposed to those provisional pricing adjustments. And in April, silver was $3 higher than at the beginning of the quarter compared to the end of the quarter. From April to June, we saw a decline of $3 in silver price. And with respect to zinc, which is a byproduct of us, we saw zinc declining from $1.90 per pound down to about $1.45 per pound. So though that steep decline in silver and zinc drove provisional price adjustments, or final price adjustments in our sales that amounted to around $6.6 million. Sometimes those things play in our favor, sometimes against us. So in this quarter, those play. So, those two things also impacted, the write down of inventories and the final settlement of provisional pricing. So, but we delivered free cash, we met production targets, cost targets. So, the business is doing quite well.
Yeah, like I always say, there's a stock and there's a business. So the business is doing well, and it sounds like you've ran into a little headwind as far as inflation and all those costs. So I guess Jorge, take us through here how you see this thing going. Those things you just mentioned, they're probably here to stay. I think you'd agree. So how does this play into future numbers?
Management needs to focus on what management can control. And, as I said, we operate assets that give us options with respect to price. What do I mean? It is my job to provide optionality to the investor. It is my job to make sure Fortuna is a good call option on prices to the investors. We all believe that, gold and silver should be higher. But while that happens, we are exposed or we would have to tolerate violent corrections. So you want to be invested in a company that's resilient and can tolerate those price corrections. And I think that's what we offer investors in Fortuna. So as I said, our largest gold producer in the portfolio today produces gold at an all-in sustaining cost of around $1,100. And we have initiatives in place. For example, we're optimizing the consumption of cyanide, sulfuric acid, optimizing diesel consumption by developing auxiliary declines and ramps in the pit to reduce fuel consumption, initiatives of that sort. And at every mine, we have levers like that we're pulling, right? But a lot of this is dictated by the type of asset, type of ore body that you have. And that's a decision that we make very early on when we bring assets into our portfolio. For example, what's going to generate the biggest impact for us, Rob, here is having the Séguéla project come into production. And Séguéla is currently, for the audience, Séguéla is a gold project that we are building in Côte d'Ivoire, in Ivory Coast. It's going to be a flagship property for Fortuna. We're going to produce in the initial years 150,000 ounces of gold at an all-in sustaining cost below $1,000. So that, and we have reserves and resources for 10 years plus of production. So you ask me, how is it that we can impact all-in sustaining cost and continue to be a low-cost producer? Well, we're doing things at our mines and always trying to optimize. But the big impact comes from Séguéla coming into production Séguéla is scheduled to be in production mid-2023, so in a few months from now, mid next year. As of the end of June, we are 66% complete with construction. And I have the latest report here in front of me from the construction team. As we speak, we're currently about 70% complete with construction. And that construction is advancing on time, on budget, something that is very difficult to achieve in this type of environment we're in, right? But we're doing a great job there. The construction team is performing really well.
Well, it seems like you're captaining the ship about as good as you can, Jorge. I didn't hear anything really negative there, except that what the conditions are throwing you. There's, like you said, nothing you can do about that. So I'll certainly look forward to hearing more about Séguéla when you get closer. But I don't know, anything else you want to impart to investors here? Any wisdom on the metals markets here heading into the fall?
Well, first, with respect to the company, I just want to stress that I just said. No, I mean, my job is to provide investors with a good call option. Fortuna currently has in total reserves, roughly 4 million ounces of gold equivalents. About 70% of that, 80% of that being gold, and the balance being silver and a bit of byproduct lead and zinc. But if we do some alchemy and convert all of that into gold, Fortuna has a reserve of about 4 million ounces of gold, and our mines produce from that reserve base. So we currently have 3 mines with 10 years plus in the life of mine models. Séguéla coming on time, on budget. So we are fully funded. We have low debt leverage, or debt to EBITDA ratio. It's under 0.5. So we're well funded, low debt leverage, good reserves. I'm feeling really good about where we are with the company. And I've been in this business all my life. I was born into a mining family, and I never seen a market, a mining equities market, so disconnected from the underlying commodity. I think that's something a bit puzzling, but I do believe that we should see the gold market, the mining equities market, has been influenced by or distracted by investments in the green energy revolution, like Tesla, lithium, nickel, and we're seeing some crazy valuations in that space. And I think at some point, gold will always come through as the true store of value, right? I am convinced of that, and sometimes that concept is tested, and I've seen it tested throughout the years, But at the end of the day, something happens and everybody comes back. So that is what I think we should be seeing, hopefully, or perhaps in the next months, right? Yeah.
Okay, well, certainly a lot of positives to build on there, and we'll look forward to seeing you here in a couple of short weeks and keep our eye on your progress. Again, that's Jorge Ganoza. He is the CEO of Fortuna Silver Mines, FSM, NYSE in the States, FVI, Toronto Stock Exchange in Canada. Again, Jorge, appreciate you taking the time, and look forward to seeing you here soon.
Thank you, and a pleasure to be here.